Why traders do this one thing? Hi, Charlie, giving you Saturday's video. Hope you're very well. So, what is it that traders do? Well, let's just let's go into some numbers right now. So, right now, I've got the euro dollar contract up, and the numbers currently, as among retail traders, is that 80% of them are long. Okay, and before some of you say, well, yeah, if the euro bounced next week, see, look, they were right. No, they're not, because their average entry on those longs, and this is the average, is 106.16. So, and we're currently at 102, roughly 40. So they're whatever that works out at 360 pips, let's call it 370 pips underwater. And that's on average, bear in mind. That's the average long price. So if that's the average, yes, it means that there will be people who have got in more recently and are still underwater because essentially the euro's right at its lows. But if that's the average at 106.16, that means that there's a load of people who are still long from right up here as well. So it's typical what goes on within trends that traders get into trades, so they see a market coming down thinking it must bounce. And this is how it all starts. So they see a market coming down thinking, well, that must bounce now. And because a lot of retail traders out there trade on gut feel and on emotions, they might have actually also traded technically at that moment in time. There's nothing wrong with buying down here, for example. There's nothing wrong with buying here or anywhere. A lot of the time, there's always going to be levels or technical reasons why there might be a buy setup. But the problem is that traders don't manage their positions, so they don't use stops. The very fact that we know that on average traders are net long at 106.16 and we're sitting at 102.40 at the moment tells us they're not using stops, and that's the average. So there's a lot that, like I said, there's a lot that who will be short from a lot higher up as well. So why do they do that? So they might even be trading technically. The trade itself might have started out with some sort of technical reason to have bought, even if they are trading with emotions. The emotional aspect is that they don't want to use stops, because what happens is a lot of the story of a trader getting into trading, someone getting into trading, is if they have learned anything and they've learned about using stops and they previously used stops, the amount of times that you do get stopped out on a trade only for so price comes down, it comes down to your entry, you get stopped out, and then a week later it's come all the way back up again. So what happens is the narrative, the story that the trader tells himself is, oh, every time I get stopped out, it always comes back up. So that's the inner dialogue that they tell themselves. And to a large extent, they're right, because they see this and they say, oh yeah, it always comes back up. Yeah, it's another one that if I had not had a stop, it would have come back for me. But you only need one. You only need on one time for a market to start properly trending when you've gone long for it to blow your account. So many of those traders right now who are underwater will be, and bearing in mind there will already been loads of traders worldwide who would have already blown accounts during this downside run, who are already out now, and there'll be a lot of traders who will just throw in the towel as well. And of course, the other thing that traders will do to try and dig themselves out of a hole will be to add. So they will be, like I said, the net average long position at the moment in the euro is just above 106, and a lot of those traders will have been adding as the euro's been coming down. And again, there will be plenty of occasions whereby if the euro bounces at some point, if it bounces enough, great, they end up, their average prices come down, so they get out, phew, maybe at break even or closer to break even, less of a loss, or maybe even for a small profit depending on where they got it. But all that does is teaches them a bad habit, because at some point that market is going to continue going down, and again they're going to blow up. It's only it needs to happen once. So what's the point in trading that way for a year, let's say, and you get away with it, and you have plenty of occasions where you go deep underwater? It's stressful. That's not healthy for you. Elevated cortisol levels, the stress involved with sitting underwater on massive underwater positions, like at the moment, and yeah, maybe it comes back up, and so you get away with it. And you could trade like that for a year, maybe more, and you get away with it, but it's stressful. But you're still trading, and it works out. But what's the point of doing that if the inevitable is going to happen, and it always does, that a market that you get into starts to trend, and it trends hard and hard and hard, and it doesn't look back, and that you're profitable over the last year or 18 months, whatever, doing that and not using stops, if ultimately you're going to just blow up your entire account, because that is what's going to happen if you do that. So why do traders do it? Why do traders fail to do it? It's that need, it's that desire to be right, and the avoidance of being wrong at its absolute core, that we don't want to have to acknowledge, oh, I had a stop out there, so to speak. A lot of traders don't want to have to take those knocks and those losses. They want to be right as much as possible, and by not using stop losses, and a lot of the time price will come back for them, that's the reason. So why do they fail to do it? It's just hardwired into our DNA. A lot of us, we learn not to do that sort of thing. Like I've said, ultimately, what's the point in being right for a year if you're going to blow up? But sometimes, traders need to learn that for themselves. So that's my general advice here today, which is please use stop losses. Engineer your stop losses according to your trading style. You can still have wide stops. It's fine if that works for your trading style. Wide stops and wide targets, but please use stop losses in your trading. We know, like I've said, 80% of retail are long right now. Now, it doesn't mean, even if the euro bounces, like I said, it doesn't mean to say they're right. Because, like I've said, you've got loads of people who have been long from way back here. So the ones who got in right down here, you can say, oh yeah, they were right, yeah. But would they have carried on being long if the price had carried on going down? Yeah, probably. A lot of them anyway. So 80% are long at the moment. I must admit that's getting high as far as the euro is concerned, as far as retail historically. So 80 to 85% of retail, when we get to those sorts of numbers, more often we're getting closer to some kind of bounce territory. But that's not a guarantee. It's just and we're at 80%, we're not at 85 at the moment. So there's still plenty of scope for the euro to still go lower. But why bother trying to catch all that? This is the trend at the moment. And so what you want to be doing is using the bounces, perhaps, to then be looking to get short and planning out your trades that way. So 80% are long at the moment, but we also know that overall it's something like, at brokers, I get told this by brokers, 70 to 80%. And so this marries up quite nicely with the numbers that I have anyway, that 70 to 80% of retail brokers' clients, of their retail clients, don't use stops. We get told this anyway. So we know that that's the sort of number of retail clients that don't use stops. And yet we know that it's actually that sort of number or more of retail traders who fail. So why bother doing what all the other retail traders are doing when we know that statistically 80 to 90% of retail traders fail? Well, why not do something different to what all of those lot are doing? And on that note, I think I've made my point here today. Have a lovely weekend. I'll see you next week.